We are in the healthcare IT space. We predominantly, specifically, are in the imaging space. The imaging space for us is comprised of the enterprise imaging for healthcare, whereas we've seen our competitors like ProMedicus, who some of you may be more familiar with, where they concentrate on specifically the radiology space. Mach7 concentrates on the rest of the ologies. That could be dermatology, oncology, cardiology, pathology. In all the various different areas of a hospital, they all produce images. What we have done is we've created a product that is a central repository for all those images to be stored. What that allows our customers to do is allows us to store all of those, consolidate some of the supply chain to reduce operating costs for hospitals, but it also allows us to serve that data back up in a clinically meaningful way. And part of that could be integrating into an electronic medical record. Part of it could be people accessing the data directly from our system. Part of it could be from hospitals acquiring their own AI algorithms, whether it's predictive analytics, operational analytics, or diagnostic tools to assist them with reading some of these studies. And our platform allows them to have a single place to integrate to gain access to all of that data. So from an enterprise perspective, it's very compelling, and it will really help these healthcare, specifically the IDNs, the integrated delivery networks, to reduce their supply chain costs. That's sort of the return on investment for the facilities. Our business is concentrated on two geographies, the US geography and the Asia Pacific geography. The US representing the bulk share of our customers. We have around 50 customers in total. And we do have a headquarters in the US, as well as an office in Singapore, which supports the Asia Pacific operations. And here in Melbourne, we have another office. We think of ourselves a little bit different than the rest of the vendors that you may be familiar with. We are one of the very few, if not the only, completely neutral VNAs, where our competitors, the GEs, the Fujis, the Highland Imaging, what they have done is they've created a vendor-neutral archive as a part of a bigger software platform. It's a component of their software that they sell, but it's by and large not what they sell traditionally. It's an add-on feature. Mach7 concentrates on this vendor-neutral archive. This is our whole business. This is what we've created our business around, and it's what we do day in and day out. That has given us the ability to be thought leaders in the space and given us the ability to create a platform unlike any of our competitors. Again, the focus really helps us. And we consider our largest competitors in the US space to be Highland Imaging, which you can read about, created from some acquisitive actions. OUS in the Asia Pacific region, we tend to deal with more of the multinational players. It's the Fujis, the GEs, the Carestreams that we compete against. And in those markets with those vendors, a primary reason a customer would choose to go with a company like Mach7 is our ability to partner with our customers. We're not just delivering a software package, a commercial off-the-shelf package, and making customers conform to our software. We are flexible enough to work with them and allow our software to become embedded in their workflow. We don't dictate their workflow. We assist them with their workflow. Our whole goal is to get clinicians access to images to provide better healthcare. That's our corporate goal, and that's what our software does on a daily basis. Some of our larger customers, the Healthcare Authority of Hong Kong, across the whole healthcare authority, our product is used to collect all of that data and serve that data back up to their custom electronic medical record to give the clinicians access to images across their entire enterprise. Some of the other large customers in the US, Advocate Aurora, is a combination of two healthcare IDNs who merged. Their whole goal with our software was to consolidate all of their images, specifically radiology images. And what they're choosing to do is they're choosing to shut down supply chain so that they're not paying these large support contracts, annual support contracts across 10, 12 disparate systems. That's their ROI. That also provides a technology stack for them that they can rinse and repeat as they acquire new hospitals. Advocate Aurora has 27 hospitals. They plan to double in size over the course of the next 5 years. We see that as a popular move forward with a lot of these IDNs. They continue to be acquisitive, and they continue to buy more hospitals. They need a platform that can scale as they grow. From a financial perspective for the company, we have not released our first half fiscal year 20 results yet. That will come out later this month, but we have just released our 4C. For our company in March of 2019, one of the largest metrics that we announced that we wanted to measure ourselves against was being cash flow positive. In our 4C, we recently released, it was around $2.4 million of free cash flow at the end of December. Considering that's the end of December, we feel like we're very much on target for the end of February to state that we will be cash flow positive. That was a very big deal for us. We wanted to prove to ourselves, we wanted to prove to the investor that we could manage responsibly our business, that we could worry about the fundamentals. We could fundamentally get our business to the point where we could start to worry about growth. We felt that it was important as a stepping stone to not get ahead of ourselves before we looked for large growth. Morgan's recently started to cover us, and in some of the projections in that coverage is a $14 million, right around $14 million in revenue for the fiscal year. We feel that we are substantially on track to hit those numbers. That will represent around a 40% growth over fiscal year 19 to fiscal year 20. We will continue to work on the growth of our company. We feel that we just did a capital raise for around $20 million in early December. The purpose for that capital raise was to, one, just to bolster our balance sheet to help us in competition as we start to bid on some very large deals. The other reasons were where we want to start to begin acquisitive actions. We're looking to grow. And part of that is to fill some of the technology gaps within our own product so we can continue to penetrate into new areas and look to bring in more deals, continue to grow our revenue. And the other component of this is that we will look from a sales and marketing perspective to make some investment as we develop our go-to-market plan over the course of the rest of this fiscal year and into the next fiscal year. So the next 18 months, we'll have a go-to-market plan that will be much more aggressive than we have been in the past, and we will continue to try to shoot for those same growth projections.